Hi folks, welcome back to Murthy Finance Academy. Today we will be discussing one interesting company from pharma space, which is none other than Shilpa Medicare. So before we proceed, a quick disclaimer: I am not a SEBI registered analyst. Whatever the companies we are going to study are purely for educational purpose. Please do not consider it as a buy or sell recommendation. So coming to Shilpa Medicare. So for Q3 fiscal 2026, Shilpa Medicare reported a powerhouse performance with 28% year-on-year revenue growth and 40% EBITDA growth and a definitive 72% surge in adjusted PAT. This operational breakout was anchored by the high velocity domestic launch of NorUDCA, Noduca, and a landmark EU approval for the rotigotin transdermal patch. The real question for the street is no longer about survival but execution. Can Shilpa successfully transition from a high capex R&D house into a high margin FDF led compounding machine without stumbling on the complex clinical and regulatory hurdles of its biologics and ADC pipeline? This transition is the result of a deliberate multi-year pivot away from the commoditized and price eroded generic API cycles that have historically suppressed the company's valuation. Shilpa Medicare has effectively decoupled its growth from the standard generic pharmaceutical cycle, reinventing itself as a diversified specialty player by aggressively moving into limited competition niches such as transdermal patches, oral dissolving films ODF, and antibody drug conjugates ADCs. The company has distanced itself from the pricing volatility that plagues pure play generic peers. While many oncology focused competitors remain stuck in a race to the bottom on price, Shilpa has interrogation grade R&D focus on complex delivery systems and specialized molecules. This strategic migration suggests that Shilpa's actual identity is no longer defined by manufacturing volumes but by its R&D heavy complex formulations and an emerging biologics platform that creates significant barriers to entry. So Shilpa's structural foundation is built on a 35-year track record and an expansive infrastructure of 10 plus regulatory approved facilities, including advanced analytical labs. This scale allows the company to operate a truly global model across 50 plus countries, supported by a heavy duty research engine of over 400 personnel. The company, which incorporated in 1987, has 400 plus specialized R&D personnel and 10 plus approved facilities with a market reach of presence in 50 plus countries. So for 9 months fiscal 2026, it generated nearly 53% of revenue from API, which is focused on oncology, non-oncology, peptides, and specialty CDMO, and 37% of revenue coming from formulations, which spans high-value tablets, injectables, ODFs, and transdermals, and remaining 10% is coming from biologicals, which is the emerging growth frontier involving biosimilars, ADCs, and GLP-1 assets. Shilpa has constructed a deep intellectual property moat evidenced by 500 plus regulatory filings worldwide, including 273 DMFs. The company has evolved into a rare dual capability player in India, possessing the technical integration to handle both small molecules and biologics. This vertical integration, where internal API captive demand feeds the formulation growth, drastically reduces supply chain risk and captures the full value chain margin. This foundation is finally translating into compounding math as the company moves into a period of high asset utilization. The company's core investment thesis rests on the transformation underway, a shift from building assets like gross block to harvesting them ROCE. After a period of massive capital intensity, the company is now sweating its 2087 crore gross block. So Shilpa is entering a phase of high operating leverage as fixed costs are spread over a higher value product mix, specifically high margin assets like Nor NorUDCA and Rotigoiton. Incremental revenue growth is dropping directly to the bottom line. This is the mechanic behind the 29% EBITDA margins reported in 9 months fiscal year 2026. The market is significantly underestimating the latent value in the biologics and ADC pipeline. Currently contributing only 10% of revenue, this segment addresses a massive TAM, including biosimilars for Adalimumab, which is having $27 billion, and Pembrolizumab, which is having a 35 billion market. Shilpa is one of the few Indian players with an end-to-end GMP grade ADC platform, which remains largely unpriced in current valuations. Shilpa is now moving from capital consumption phase into a capital harvesting era, addressing massive external market opportunities with a prepaid infrastructure. So Shilpa is perfectly positioned to capitalize on the strategic tailwinds within specialized pharma and the Indian domestic formulation market. The company's integrated model allows it to act as a one-stop shop for global biotech partners, simplifying their supply chains. The opportunity for Noduca brand is vast. Non-alcoholic fatty liver disease affects 25% of the global population with a staggering 188 million potential patients in India alone. Shilpa is the first company globally to obtain approval for the NorUDCA molecule in this indication. And the 9 months fiscal year 2026 financials include a one-off exceptional expense of 10 crore related to the government of India's new labor codes. While this impacted reported PAT, the underlying adjusted performance shows a clean breakout. And Shilpa's dual capability in small molecules and biologics provides a competitive advantage that few domestic peers can match, particularly as global pharma looks for integrated CDMO partners for complex NBEs. Coming to its unit economics per segment, its API oncology, which is a foundation pillar showing consistent captive business and market share gains in core oncology molecules. And its non-oncology API is driven by aggressive capacity expansions in UDCA and tranexamic acid, catering to global demand. And EU formulations, a high margin engine, revenues more than doubled in Q3 fiscal year 2026, propelled by Nilotinib market share gains. And coming to domestic formulations, transformed by first-in-class Noduca launch, supported by 3 strategic partnerships and a dedicated specialized force. US formulations pivoted to a value over volume strategy with sustained traction in specialized 505B of 2 assets. In coming to biologics, the high value tail assets like Adalimumab and Aflibercept are progressing through global filings, targeting a $10 billion average product size. And coming to specialty CDMO, it is managing 25 plus active programs for global biotech partners, focusing on complex polymers and NBEs. Its ADC platform, a unique end-to-end vertical with GMP facilities targeted for Q4 fiscal year 2026, one of the few such capabilities in the Indian market. So for the 9 months fiscal year 2026, performance is a classic case of bottom line acceleration. While revenue grew 14% year on year, adjusted PAT surged 128%, proving that the company has crossed its operational break-even point on its specialized investments. Its gross margins hit 71%, up by 300 basis points, driven by the higher value mix of Noduca and EU formulations. This margin expansion is the so what of the entire pivot. And coming to balance sheet transformation, it's the deleveraging is the primary thesis pillar. Shilpa has aggressively reduced its net debt to EBITDA from 6.7 times in fiscal year 2023 to a lean 1.4 times in 9 months fiscal year 2026. And coming to its earnings trajectory, the quality of the turnaround is best seen in the 9 months fiscal 2026 PAT, which has already nearly doubled the full year performance of fiscal year 2025. So Shilpa has moved from a debt heavy, asset heavy expansion phase to a cash generative harvesting phase. With net debt to EBITDA at 1.4 times and accelerating PAT, the balance sheet is now a source of strength and not a liability. Coming to some con call highlights, Mr. Vishnukant Bhuttada's recent commentary suggests a management team is pivoting from growth at any cost option to capital efficiency. In third quarter fiscal 2026, the company delivered 28% year-on-year revenue growth, achieving its highest quarterly revenue and EBITDA. So this confirms that heavy lifting phase of capex is officially behind them, and the operational momentum is also translating into improved capital efficiency as seen in its improved ROCE. So the move from 3.4% ROCE in fiscal year 2023 to 17.1% in 9 months fiscal year 2026 shows management is finally harvesting capital. So the company is also significantly confident in bettering its fiscal year 2027 performance. So this puts the focus squarely on the Rotigotin EU launch and the RHA clinical progress as the next catalyst. So management's credibility has been restored by the dramatic ROCE recovery and successful deleveraging. However, there is a notable tech and AI gap. The absence of AI-driven drug discovery in the pipeline management is a potential long-term disadvantage compared to global specialized peers. The quantifiable turnaround from fiscal year 2023 lows is substantial. By delivering on debt reduction and high barrier approvals for Rotigotin and Noduca, management has earned the benefit of the doubt for its bullish fiscal year 2027 guidance. And coming to it, some of its KPIs, its adjusted ROCE is standing at 17.1%, which is a dramatic recovery from the 3.4% loss of fiscal year 2023, signaling that invested capital is finally yielding returns. Coming to its net debt to EBITDA at 1.4 times, significant de-risking of the balance sheet from 6.7 times. And coming to its gross block, which is at around 2087 crores, a prepaid growth engine where incremental revenue requires minimal incremental capex. And coming to DMF filings, which is of 273 filings, continued R&D velocity with new 9 filings in 9 months fiscal year 2026 alone. So valuing Shilpa Medicare requires looking forward as historical averages are anchored in a distressed debt period that no longer applies to the current margin rich profile. So, while specific peer multiples are not in the source, because this is a very different type of a peer pharma company. So, the logical framing is a move toward valuation seen in integrated biosimilar and injectable players like Biocon or Gland Pharma as the mix shift towards the biologics. So, in a bear case scenario, unexpected EMA delays for the Rotigotin launch or clinical failures in the high cost ADC human trials could cost the company. And in a base case scenario of 25 to 28% EBITDA margin sustained, steady domestic ramp up of Noduca and successful Rotigotin EU launch could help the company re-rate further. And if in a bull case scenario, if global phase 3 success for RHA supported by the Orion partnership, major out licensing of the Pembrolizumab and Adalimumab pipeline. So with a 17% ROC trajectory, Shilpa is no longer a recovery play but a specialized growth story. The market has likely not yet priced in the multi-billion dollar upside of the biologics or ADC pipeline. So coming to some key risks which I observed in this company are execution risk is the highly complex ADC and biologics human trials slated for fiscal year 2027. Clinical setbacks here would be capital intensive. And coming to second risk, regulatory dependency for the Rotigotin EU launch in first half of fiscal year 2027, and any EMA delays would disrupt high margin formulation forecast. And coming to the risk 3, price volatility and concentration risk in the oncology API portfolio, which remains a core but cyclical revenue driver. So, what are the some key monitorables need to be tracked in this company? Are semaglutide validation, which is targeted in the for the next quarter, and Rotigotin EU launch, which is scheduled for first half of fiscal year 2027, and RHA phase 3 initiation, which is targeting the India and EU in fourth quarter of fiscal year 2026, and Ondansetron ER launch, which is planned for in 2026 in the first of India, and ADC human studies, which is targeted initiation in fiscal year 2027, and deleveraging, whether maintenance of net debt below 1.5 times or not, and biologics mix, tracking the move from 10% toward to 15% plus revenue share. So, what is the verdict for this company? If you ask me, Shilpa Medicare is a classic asset sweat story where years of R&D pain are finally yielding high margin gain. The investment case is clear: a successfully deleveraged balance sheet, an optimized product mix, and an escalating ROCE. While execution risk in the biologics pipeline are real, the fundamental shift from an asset heavy past to a value rich specialized future is undeniable. Shilpa is currently a mispriced transition story that the market is only beginning to interrogate. Hope you like this video. If you do like this video, please do like, share, and subscribe to Murthy Finance Academy. Thank you.